What's up, traders, and welcome back to Explain the Charts. Today is November 27th, 2025, and we are doing an in-depth analysis of EURUSD, which has seen some incredible movement lately. The biggest story driving the market right now is a major policy divergence between the world's two largest central banks. On one hand, the market is pricing in an 85% probability of a U.S. Federal Reserve rate cut in December, signaling a significant dovish shift. This is fueled by weakening U.S. manufacturing data and a general risk-on sentiment in the broader markets, which is pulling capital away from the safe haven dollar. On the other hand, the European Central Bank has confirmed the end of its easing cycle, with officials stating current rates are appropriate. This fundamental difference is putting immense upward pressure on the euro relative to the dollar. Now, let's see how this powerful narrative is playing out on the charts. Starting with the daily chart for the long-term perspective, we can see the bigger picture. After peaking above 1.19 in mid-2025, the pair entered a multi-month downtrend, finding a bottom near 1.01 in January. From there, we saw a strong recovery into the spring, followed by another downturn over the summer. Price action was looking quite bearish through September and October, setting lower highs and lower lows. However, this narrative has completely shifted in November. We have seen a powerful rally off the November lows near 1.03, which has accelerated dramatically in the past few days. Let's zoom in on the action since September to get a clearer view of this breakout. As you can see, price was grinding down, finding resistance repeatedly. The area around 1.1550 was a key battleground in late October and early November. The market tried and failed multiple times to break through this level. But this past week, fueled by the dovish Fed expectations we just discussed, buyers smashed through that resistance. This is a classic example of a fundamental narrative driving a technical breakout. The candles for November 25th and 26th are particularly strong, showing large bodies and closing near their highs, which indicates very strong buying pressure. With the 1.1550 resistance now broken, it should theoretically act as our first major support level on any pullback. Below that, the psychological 1.1500 level offers another floor for the price. Looking up, the path of least resistance has a clear, immediate target. The next major obstacle is the high from June 12th, right around the 1.1630 level. This is a critical test for the bulls. If we can clear that, the door opens to targets higher up, such as the 1.1728 resistance from late June and the October peak. Ultimately, a break of 1.1630 could signal a run towards the summer highs around 1.1830. Now, let's switch to the 1-hour chart to analyze the structure of this recent rally. Here we can see a beautiful, clean uptrend over the last few days. The series of higher highs and higher lows is very clear, which is exactly what you want to see as a bull. Notice the minor consolidation that occurred around the 1.1580 mark before the latest leg higher. This 1.1580 level now becomes our most immediate, short-term support level to watch. Currently, the price is consolidating in a tight range just above 1.1600. This looks like the market is taking a brief pause and building up energy before attempting to challenge that key 1.1630 resistance we identified on the daily chart. For those of you trading on even shorter time frames, let's drill down to the 15-minute chart. Over the past several hours, we can see price is coiling in a very tight range. The upper boundary is roughly 1.1604 and the lower boundary is around 1.1594. This is a classic consolidation pattern before a potential continuation move. A decisive breakout above 1.1605 on high volume would be a bullish signal for a quick trade targeting the 1.1620 to 1.1630 area. On the flip side, a break below 1.1594 could trigger a small pullback, with the first target being that 1.1580 support level we saw on the hourly chart. Pay close attention to this range, as its break will likely dictate the next short-term move. So, to quickly recap the important price levels to watch for EURUSD. Our critical make-or-break resistance level is at 1.1630, which is the high from mid-June. A break above that opens up targets at 1.1728 and potentially the 1.1830 zone long-term. On the downside, our support levels are tiered. We have minor short-term support at 1.1580. Major support lies at the recent breakout point of 1.1550. And below that, the significant psychological level of 1.1500. Now for some unbiased predictions. Given the powerful fundamental drivers and the strong technical momentum, the bullish continuation scenario appears most likely. I'd assign it a 70% probability. This scenario involves a test and eventual break of the 1.1630 resistance in the coming days or weeks. This view would be strengthened by continued risk-on sentiment in equities and any more confirmation of a dovish Fed. The second scenario, a bearish pullback, has around a 30% probability. This would most likely be triggered by a failure at the 1.1630 resistance, leading to profit-taking and a correction back towards the 1.1550 support. A surprisingly strong U.S. economic report or hawkish comments from a Fed official could be the catalyst for this reversal. The key thing to watch is how the price reacts to the 1.1630 level. Its reaction there will tell us a lot about the next major move. As always, manage your risk accordingly. That's all for today's analysis on Explain the Charts. If you found this video helpful, please hit the like button, subscribe, and ring the bell so you don't miss our future updates. Please remember, this content is for informational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always do your own research before making any investment decisions. Stay safe and happy trading.